And as I already announced, it is, to conclude this session on crypto custody, another panel discussion moderated by, again, my friend and former colleague, Benjamin Schaub. Benjamin, would you like to introduce your panelists? One is here physically. I'm especially grateful for that, but I think you'll get to that.
Thank you. Thank you, Marcel, again, for the warm welcome. And also from my side, a warm welcome to everyone to the panel discussion, Is Crypto Custody One Size Fits All? My name is Benjamin Schaub. I'm a consultant at Inters Tech, which is a blockchain consulting firm that was recently founded by the Frankfurt School and by Pluto Neo. For our panel discussion now, I would like to welcome Seamus Donoghue from Metaco, Martin Kreitmeier from Tangany, Tim Brunius, who is apparently in Frankfurt. Hi, Tim.
Good to meet you all.
Chris Haselwanter, who's also here with us now from Riddle and Code. And last but not least, Lior Lamesh from GK8.
Hello.
Hi. So before we get into discussion, I would like to ask everyone to introduce themselves briefly. Who would like to start? Maybe Seamus, you begin.
Hi, Benjamin. Thanks for having me back again this year. So Seamus Donoghue, I'm the VP of Strategic Alliances at Metaco. Metaco provides a main product, Harmonize, which is an institutional orchestration platform enabling businesses to secure, trade, issue, and importantly, manage digital assets.
Thank you, Seamus. Martin, would you like to continue?
Yeah, sure. Also, thank you for having me today. My name is Martin Kreitmeier. I'm one of the co-founders and managing directors at Tangany. Tangany is a white label crypto custodian which provides an API solution which can be integrated in any kind of software solution on our client's end. We are also regulated, which means we not only bring in the tech solution, but also a regulatory framework for the German market. And we are based in Munich, and I'm looking forward for today's panel.
Thank you, Martin. Tim, please.
Yeah, so I'm Tim Brunius, head of sales for Fireblocks here in Germany. And for the ones who don't know Fireblocks, we are a globally operating financial technology company offering institutional-grade asset security infrastructure for moving, issuing, and transferring digital assets.
Thank you. Chris, please, a short introduction from yourself.
Yes, hello. Thank you for having us. I'm Chris Haselwanter. I'm the Chief Operating Officer of Riddle and Code. We build hardware and software stacks and focus primarily on the tokenization of physical assets, but we also have a fully fledged industry-grade token management platform to handle crypto assets of all kinds.
Thank you. So, Leo, it's up to you.
Sure, pleasure meeting you all. I'm co-founder and CEO at GK8. My background is cybersecurity at the level of national security. I used to work for the Israeli government, protecting the strategic assets of the country from cybersecurity attacks. At GK8, we created the first true cold vault that can make blockchain transactions without the need for being connected to the internet. Our technology paired also with the MPC for automatic high-frequency transactions. We are working with the banks, exchanges, and financial institutions that are interested in offering custodian, DeFi, staking, and tokenization services by themselves using a self-managed product. We have clients that are managing billions of dollars value of cryptocurrencies using our solution, including eToro, Prosegur, and more. And I'm very excited to be here today.
Thank you. So let's start by shedding some light on what kind of customers your companies have and what requirements profile looks like for your customers. Who would like to kick it off? Tim, maybe you?
Yeah, sure, I can kick this off. Look, from a Fireblocks perspective, clearly what we see as a business case and use cases, discussions around direct versus sub-custody. I mean, most of the clients and prospects we deal with are looking for a direct custody model, i.e. securing and storing their own digital assets, i.e. private keys, directly on their own premises. So that's clearly one discussion we have. And there's also another discussion around offline versus online custody, i.e. putting things into cold storage and moving them as needed into an online environment. So clearly these are the two kind of vectors we see as parts of the discussion. But the overarching conversations we surely have are about the direct custody model, i.e. empowering banks and financial institutions at large to run their own custody business.
Thank you. Who would like to add something?
Sure, happy to jump in. So I think our customers, if you join my last discussion, I think we work with banks primarily, or financial institutions, infrastructure providers to them. But I think in that context, we work with like most banking use cases, whether it's a retail bank, private bank, crypto native banks, security services, universal banks. And the nice thing to say is, compared to 2020, I think basically 2021, we're seeing broad interest from our clients are seeing broad interest from all types of clients, whether it's the asset manager to high net worth individuals. The institutional demand they are seeing is quite strong, and I think is growing. We can see that in the traditional space, where we've seen whether it's corporates or asset managers all vocally get involved in this space. So I think the demand is broadening, and I think to Tim's point, there is obviously the debate about whether it's self-custody or sub-custody. And I think that was one of the reasons we basically have tried to really enable firms to manage what's potentially a very complex decision to make. How do we start? And I think that was some of the large institutions are struggling with that decision. Some of the smaller ones decide they want to be cautious, externalize it to a custodian, but with the eventual view basically that they'll bring it add self-custody at a later date when they validate their business case. Others, maybe asset managers want to manage multiple sub-custodians. And to the discussion, there's no one size fits all on the self-custody side. They may have multiple use cases for larger firms that want to have hot MPC, a cold air gap solution, a cloud-based solution. They may have multiple use cases that require each. So it's really, we've viewed it, the space is getting more complex, but that's why we need solutions in the market, which is why we deliver Harmonize to make that decision process easier and really not be so critical in terms of your future path.
Thank you. Would anyone like to conclude on that?
Maybe I can add to that. We are, I think, a little bit different than my colleagues in the sense that I mentioned in my presentation that we are focusing on the tokenization of physical assets, meaning we started actually out with a custody service for the banking system, which was an extremely steep learning curve to understand the necessities to become a licensed or regulatory accepted company with all that comes with this. But we are distinct in the way that we have a set of hardware to connect our custody service, what we call a token management platform, to physical assets and prove the origin or prove the correctness of the data. And that, of course, leads to a different set of clients in the energy sector, where we work with energy grid providers, or, for example, in the automotive and mobility sector, where we work with OEMs like car producers, if you want. For example, the car wallet that we create with Daimler is one of such an example. But we are also invested in the steel area, where we tokenize certificates. So that means we have one end-to-end tokenization management platform, but it caters and links to different industries and different clients.
Okay. Martin and Leo, would you like to elaborate on that, or should we jump to the next question? Okay, please, go ahead.
So I very much agree with Seamus, actually. First of all, in a manner of two major segments, I would take it to banks on the one end and exchanges on the other end. Banks mainly interested to start with the crypto custody service as the most basic one to start with. They mainly want to focus with the most basic currencies like Bitcoin and Ethereum. And obviously, they're focusing on how to meet the regulatory compliance and control requirements. For example, there are some regulators that don't agree to use only hot wallet-based solutions such as MPC, but they also need other security. On the other end, exchanges are looking for a larger variety of assets, and maybe they're more looking for a cheaper price. And I really see that eventually it's easier to start with a third-party custody, right? But it looks like the end game would be self-managed solution. Banks eventually do money out of money, and it doesn't really make sense to take the money they are getting from their clients and moving it to another banks. So I clearly see that as the market is keep going, the banks will secure the assets themselves. It can improve their level of service, the availability for immediate transactions, and the flexibility for adding additional services on top of the custody.
Thank you.
Yeah.
So Martin.
Yeah, sure. So what we see is the complexity is increasing. If you take a look on the market 2 or 3 years ago, the clients were looking simply for a custodian solution and didn't have more information beyond that. It was only about self-custody maybe and custody solutions. And if you take a look now, what they're looking for, at least where our clients are coming from, they have a very clear expectation what they are looking for, whether it's MPC or HSM, it's code or online storage, it's multi-sig or other solutions. So we see that the clients have more knowledge about custody and how it can be done. And I believe that's a very, very good thing, because we have a lot of providers also in the throne now today, and they all provide a very unique, specialized service for different use cases, whether it's MPC or HSM or API-based or a full service solution that can be hosted on-premise, or even meta solutions which include different custody solutions or storage solutions. And with that given, I believe it's a very good trend to see that the people and clients have more knowledge and really know what they're looking for, and with that the different services on the market can specialize in their own direction.
I think also,
thank you.
Like to really add on this one very quickly, like one important consideration is really around like the starting point, the foundational layer is surely your custody decision, right? So self, direct custody, non-custodial, external, internal. And then really building up the use cases on top of that. That's what we see at Fireblocks specifically. The next one, namely being trading, like how do I actually execute these trades and the assets which have been put in storage specifically somewhere. And then it really goes also, and these are discussions happening today, how do we access DeFi? So the client demand is really pushing them, but again, it's an evolutionary process, starting with custody, going into trading models, and then really like very quickly thinking about how do we access any other business models we might want to offer to our customers in the end.
Thank you. So as we can see from this panel, the ecosystem is very diverse already, I would say. And I think for many potential clients of your, this decision-making process is quite hard. How to decide which crypto custodian solution fits best. And so I would like to elaborate on that a bit. And what are the actual solutions clients have?
So do you think what they're looking for, what their business case is?
As you like. For me, it's important to point out that there are different solutions available, as many of you touched upon. For example, cold storage, hot storage, warm storage. So what are the solutions clients have, and how could the decision-making process for them look like? Because I think that the ecosystem is extremely diverse and it is hard to pick the right custodian.
Yeah, if I may. So yeah, it's absolutely true. And I believe the clients or the customers need some kind of guidance here to really evaluate which solution is the right for their purpose. So do they have the capability to develop their own front end? Then it might be an API solution. Are they looking for an all-in-one solution? Then it might be another solution. Cloud versus on-premise, which is also a very important topic in the financial industry when it comes to banks. So I believe there needs more information about the different solutions on the market, more overview, who is doing what and what is the perfect fit for what custody solution. But I believe we are already heading in that direction because it gets more clearer every year, at least in my opinion, and how I see the market. So, but it's still a lot of things to consider. And of course, the client needs to understand what are the differentiations and what does it mean for their long-term purpose or goal with the product. Is the solution they're choosing today capable to fulfill their expectations in 2 or 3 years from now. And that's a lot of information they need to gather and to really evaluate carefully.
Thank you.
Yeah, I mean, I would add to what Martin's saying. I think a few years ago, people thought custody would be a commodity. I mean, I don't think I think it's mature. And as you say, there's a lot of specialized solutions in the market, and they're quite mature and advanced. You can have a great air-gapped MPC-based solution. You have a great, MPC wallets. You have hardware-based wallets that are super secure and highly scalable. I think the main point, and I think we've traditionally competed in that space, and I think increasingly it's a do you want do you want hardware? Which hardware? Is it cloud or on-prem? These are all choices the clients can make. But I think the bigger picture we realized is, I don't think there's a single solution that's going to fit all the clients' needs today and tomorrow. I don't think it's true to propose that. I think what we see in the practice is clients start with one solution, want to add a different type of solution, maybe for different features, different capabilities. And what they end up with is multiple solutions. So, I mean, I think there's equal reason. We have a good wallet solution. I think everybody in the call probably has an equal wallet solution. I think the question is, how do you manage multiple solutions? Which is why we've stepped a little bit away from the custody space, saying it's a mature space. You can take our wallet, don't take our wallet. The likelihood you're going to need multiple from any of the guys on the call or other good solutions to the market. But why not? You need it. You don't want to integrate too many times in your core infrastructure. Once is enough, particularly if you're a bank. So that's why we deliver this harmonized layer, saying this space is too complex. It's evolving too quickly. You need options going forward, whether it's diversifying vendor risk, as we've seen because a big provider is recently acquired, or there's different use cases. How do you orchestrate and manage them all? So I think there need to be a new solution to give you that optionality to simplify what is a highly complex and rapidly evolving space. So that's why we basically recently launched with one of our major clients, Standard Chartered, this solution called Harmonize, to abstract all of the complexity into a single layer for a single policy engine, a single accounting layer, a single integration point into your core infrastructure. So you can basically build and you're future-proof in your stack, basically.
Thank you.
As we see that the three major vectors that clients are testing are mainly, and first of all is the security. Obviously now as the traditional institutions are already in the market, it's not only the money they can lose, but also the large reputation damage they can have in place. What they also checking is the compliance with the regulatory requirements. For example, the need to have anti-money laundering capabilities integrated to the product, or even the way to make crypto balance attestation by some big four auditors. And obviously the insurance. There are some solutions that can provide up to like tens of millions of dollars. And for example, at GK8, we provide $500 million of insurance per vault, which we see that as something that make the bank feel very comfortable and they need that peace of mind in order to start operating.
Thank you. Would someone like to elaborate?
Yes, I'd like to add it from a different point of view. I think we all agree crypto will not go away. Like crypto assets in whatever form they will stick. And it's accepted to some ways now, not everywhere, but most globally. Even the banks and even the regulators start wrapping their heads around. As people understand, and let's put it differently, we spent the last few years in finding out, once you have a digital asset, actually, how do you create it and how do you secure it? And that's the main task of a custody service. But now people say, all right, I own it, you take care of it, but I want to do something with it. And that's why the DeFi hype. Also, because with the normal fiat money, there's little products they can invest in and that gains them reasonable interest. So they do it in DeFi. But Liam, as you correctly pointed out, the players, at least that's the feedback that we already get, the custodians, they just shuffle the money from one to another place. Yeah, basically paying other providers the fees, which basically ruins their business model. So they have to come up with their own ways of creating new products and not just link to other DeFi providers. And that's, I think, the hard thing. And that will exactly, in my view, dictate what kind of custody solution a company is looking for, because it needs to have this ability to build business logic on top.
I mean, from my vantage point as Fireblocks, I mean, we're obviously large proponents of a direct custody model, i.e. empowering banks and financial institutions to run their own custody business as kind of the foundational stack here, right? We do obviously see also the need for a sub-custodian network, and that's also part of our network where we can deliver exactly that situation where the technology is being given by Fireblocks, but then there's a sub-custodial network underneath for the ones who really don't want to be the custodian of assets. I mean, our role is also to really guide our prospects and customers on the journey of from a custody layer towards a trading layer, but also what's really happening out there in the DeFi world, which will become more mainstream by the day, and the need for a bank to offer staking and lending will become a question as we further venture down the road.
Thank you, Tim. So another topic I would like to talk about is around insurances. What role do they play for your business, for crypto custody, and how well do they understand your business so far? Are they at the moment too expensive? What can we expect? So what's the situation right now, and what can we expect over the next 1 or 2 years?
Maybe I start. Certainly, insurance will always be important. We all grew up in a system where we have a regulated company who guarantee that the money doesn't get lost. In crypto, it's a bit different because if you look at the DeFi hype, it basically, the entire business is based on synthetic contracts. Now, if the money is lost, who done it? That's the main question. So who is the culprit and who is accountable for it? And I think the difficulty is with all the different chains, with all the products, insurances, but even companies and clients as well, have a very, very hard time to understand the complexity of a transaction. And that means applying standard insurance conditions on such a product is almost an impossibility. And that is the reason why most of the time the insurance fees are just way too high. But I believe that in the future, maybe we have to deviate from the classic insurance model where I insure a company in the case it gets lost, but it's rather than maybe even auditing the underlying contracts, because there is where the break probably happens most of the time.
So insurance plays a big role when it comes to the regulators as well. First of all, I think that eventually insurance is a matter of risk, and the risk in this case is derived by the importance of security. And this is something that is very important to elaborate on, right? Eventually, there's a difference between making custody for traditional institutions compared to crypto or blockchain-based assets, right? In order to make custody for traditional institutions, what you need is like a bunker and army around it to protect it. But when it comes to crypto assets, you need the right way to manage the private keys. Now, today, there are two major solutions, old and cold wallets. Even the most secure hot wallets that based on a multi-sig or multi-party computation are not necessarily secure enough. What hackers can do is to invest a few millions of dollars in order to potentially compromise a few different internet-connected computers and steal billions. On the other end, there are some cold wallets that are not really cold, as at some point they receive input from the internet. So there is a different approach that is needed in order to provide the needed risk, so insurance will feel comfortable to make insurance with the needed capacity that banks are need. At GK8, we are tackling this approach by providing the only true cold wallet that can make blockchain transactions without internet connection, manage the majority of the assets, along with the MPC to manage small amount of assets. So really change the equation for hackers here. And we see that this is something that's very helpful for the insurance to provide the needed amount of insurance.
I mean, I would just add, I think that maybe worth giving context around the insurance market. The insurance market is really bifurcated between two types of species insurance and crime. And species is very much focused on cold storage solutions. So This analogous to banknotes in a vault. Basically, a fully air gap solution is considered as secure as that. So there's a large underwriting capability for cold storage market. I mean, the pricing there is somewhere in the order of 40, 50 basis points. But as you get into the connected environments, it's really as Leroy's pointed out, it's a technological question. This question of how hard and how long, and I think one of the main how long it takes to break in. One of the issues is that the underwriters are not technologists. So really bridging that gap, I think there is limited capability to, let's say, understand and to underwrite that space. So that I would think from an industry perspective, that is one of the constraints. It's a KPI for every one of our clients that your infrastructure is insurable. We do the due diligence for those underwriters, so clients can get insurance. But importantly, I think that's really where the innovation needs to be. There needs to be a bridging of basically this underwriting capability and technology, because if you're spending potentially 200, 300, as high as 350 basis points to ensure a connected environment, it's a huge impediment. Basically, the pricing is exceptional in the market, but still for that.
Yeah, it's the same what we are seeing. Cold wallet is a product that insurance service providers can grab, where they have some basic knowledge, because it's not about the tech solely, it's also about the operational process behind the cold wallet solution, and they can rate it, they have a feeling for the risk in lying to that product. But when it comes to online connected wallet solutions, there are so much different approaches on the market, how that products can look like and how the client can use, that it's nearly impossible for the underwriter to really have a full overview of the risk that he's taking by insuring that product. And that is a very, very huge challenge for the market to find a solution to become more or easier to be insured, because there is no standardization on the market. And another trend we are seeing is there are a few insurance products, of course, they are premature maybe, which are based on the blockchain itself, which are going into a wallet insurance policy rather than a company insurance coverage. They are still young, but it's a very interesting concept for going into smart contract insurance and going to wallet insurance, and to delegate the insurance effort from the company, from the custodian to the user, to the client. That might be a solution, or will at least give a little bit pressure to the market for insurance service provider to look at the market and to come with an own proposal for the market.
Yeah, look, my take on this.
I would like, yes, exactly, Tim. Yes. You have the closing word.
I have the closing word, okay. So on insurance, my take is obviously the less understood technologies, the less scaled technologies also obviously are being penalized with higher insurance fees. So it really comes down to, as my colleagues have said and co-panelists said, understanding the technology, going deeper in researching and building up insurance programs also. And again, that comes to a huge benefit of being allowed and being able to actually insure at large scale capacity.
And if I can add just one sentence to that, I think rather than discussing the price of insurance, it's about a strict regime and a clear regime of accountability. So who is accountable for which part of the risk alongside the value chain? I think once we have figured that out, it will be easier to have insurances.
Thank you. So, unfortunately, we have to wrap it up. Thank you again for participating. Seamus Donoghue from Metaco.
Thanks.
Martin Kreitmeier from Tangany. Tim Brunius in Frankfurt for Fireblocks. Chris Haselwanter from Riddle & Code. And Leo Lamesh from GK8.
Thank you.
Bye-bye. All the best.
Thank you very much.
Thanks, everybody.
Thank you, guys. Bye-bye.
Bye.
Thank you, all of you. Thank you in particular because you're still hearing me. And thank you, Benjamin, for another great panel.